Welcome to Leaders in Lending. I'm your host, Jeff Keltner. This week's episode features my conversation with Matt Deines, the CEO of First Fed Bank. First Fed's a community bank based in Port Angeles, Washington, which Matt tells me is the northwest corner of the Northwest region. I think it was a really fascinating discussion. Matt starts off by telling me why he thinks digital transformation is really the wrong objective and how you should really think about that. It's not saying digital is not the future, but it is saying that thinking about it as digital transformation might lead you astray and how you think about what's really important about that. Matt kind of dives into their fintech journey. They've made traditional partnerships with fintechs, but have also done some interesting approaches, including a joint venture that I think is really interesting and can talk about why different approaches may make sense, but also the skills you need to be effective in developing and building fintech partnerships to build better experiences for customers of your bank. And finally, dives into a couple of different opportunities he sees across the credit spectrum, maybe different ways to add value and meet the needs of your customer and really take advantage of missing opportunities in the market that others aren't capturing. I think it's a really fascinating conversation. Lots of great nuggets for everybody. So please enjoy this conversation with Matt Deines, the CEO of First Fed Bank. All right, Matt, I appreciate your taking time today to join us and share your thoughts. Really, really helpful.
Jeff, thank you so much for having me. It's truly an honor and looking forward to the conversation.
Yeah, I was really struck by something you said earlier because there's probably no topic that comes up more often as a critical thing that every bank needs to be focused on right now than digital transformation. And my understanding is you feel like that focus is misplaced. So tell me a little bit about your thoughts around digital transformation, because I feel like you can't have a conversation with the banker the last 10 words if less 2 of the 10 are digital transformation.
Well, I don't think there's any question about that. And I do think that we've all been on a digital transformation journey for a long time, all the way back to ATMs and first using computing equipment, and then obviously going from green screens in a lot of
I used to sell green screen machines, believe it or not.
Yeah,
that was
well,
like my
there
first
you go.
job in tech.
And then the upgrade into some sort of GUI interface and whatnot, and all the way along and rolling out online banking. Would that be the end of branches? And then, of course, into mobile and bill pay and so many other technologies that have come along, and some of the things that are happening today that are somewhat mind-blowing, how much our industry has changed. But, the reality is, especially for community financial institutions, it really starts as a cultural transformation and really a way of thinking about our business and really providing an understanding about what we're trying to accomplish here. We're trying to provide better service and more value, less brain damage for our customers so that they will want to stay with us and that they won't leave us to another bank or fintech. And that they will give word of mouth referrals or be raving fans of ours. And so, of course, we want to create great platforms, great technology experiences, but we also have to understand what the primary goals are, what we're trying to accomplish. And just getting better tech or better UI doesn't do the trick. We've really got to make sure that we're focused on our ultimate goal of growing business, of creating better brands and better awareness and relationships with our customers. And you can't do that even with the best technology. It's really got to be a mindset in how we go about running our business.
I think it's an interesting point, the starting with the cultural transformation. And I like that your third point is less brain damage. I mean, usually it's more and better is what we all focus on, but less brain damage is good because certainly many financial services involve a lot of brain damage to the customer in acquiring them. Talk to me about how you approach cultural change and what you think that means, because I think maybe sometimes we focus on the digital transformation because it's such an obvious, did it get executed or not? Did it launch or not? Can I open my account on my phone or not? Is like a yes, no. And cultural transformations are harder to quantify, harder to drive in some ways, harder to know what's working and not. How do you think about how you effectively do that and how you measure your success in shifting a culture? I think it's a much harder problem.
It is, but it's also a lot of fun. I think you have to start out with a vision, and then you have to communicate that vision about what you're trying to accomplish. And I think you have to sometimes over communicate. I think sometimes executives keep things close to the vest. One of the things that we've done here at First Fed is we've talked a lot about what we're trying to do and why we're trying to do it. I think there's a fear, and I think it's largely unfounded with a lot of legacy or traditional bankers to think, well, they just want to replace me with a machine. They want to replace me with an app. And that's really not the case. I mean, we think about this outside of the industry. There's 11 million jobs available in the JOLTS report and not enough people to fill those jobs. So that's really not where we're going. What we have set in our organization is a concept called HERE, which is hire the best people, empower them, hold them accountable, and reward them. And we think those are the important things. Good people want to be held accountable,
Mhm.
right? But they need to be empowered to make good decisions and do things on behalf of our customers. And of course, if they do those things well and they follow the good guidance that we give them and the best principles that we give them, and they bring in great business and we're successful, then we reward them and we all get rewarded together. So, that's a big part of it. I think there's so many great ideas from within every single one of our organizations. And they have to be told, like, hey, I want to hear what you have to say. We talk a lot about inclusion. Well, a big way to provide a higher level of inclusion is to ask people, what do you think? And it seems like a simple question, but it's amazing when you ask the answers that you might hear.
Yeah, no, I love you've got the acronym here. That's a really nice acronym. And one of our executives, I think as we've grown as Upstart, it's interesting you talk about over communication, and I think it's easy, particularly in a leadership group, to know what's going on and not communicate enough. And one of our executives uses the phrase all the time: repetition doesn't spoil the prayer. And I think about that a lot. That to really get the message across, you've got to repeat it constantly. Probably by the time you're sick of it, they're just starting to understand it and really internalize it. So you got to really do that. I did want to talk to you about execution of digital. When you see these technologies, how do you think about, in the context of cultural, where it makes sense to apply digital, where maybe you focus on a more one-to-one or traditional relationship approach, and how you measure the success of like a deployment of a technology or the choice to deploy a technology against a solution versus a human-powered operation, which I think sometimes is the right answer.
Yeah, I think it depends on what you're dealing with and who you're marketing to and who your client base is or who you want them to be. And so, there are technology solutions for so many things, whether or not that be something as simple as accounts payable or whether or not that be an account opening solution. What we're really trying to do is to make things more convenient for our employees and our customers. And I think there tends to be an overemphasis sometimes on business development, new customer acquisition.
Mm-hmm.
There also needs to be an opportunity to say, how do we make your jobs easier? How do we take
Yeah.
our people and put them in the position to have the bandwidth to add value? Because those relationships do matter. And particularly in community banking, a big reason why so many folks come back to their community banks or community financial institutions is because they want that value add, whether or not it's advice, whether or not it's
Mm-hmm.
just a smile or, hey, can you explain this to me? Sometimes there's things that a chatbot or an FAQ can't supply, and maybe the answer is the same. Sometimes it's just the packaging that you give it to them in. They want to know that there's someone there that they can talk to when they have a question or a concern.
Yeah, I think that's so true. That I mean, I certainly find that there are moments when I want that person, and the more you can empower, that's your second, right? Empower that person to actually add value and be enabled with the right tools to do that. I think the more happy your customers are, but also your employees tend to find that more rewarding, right? I think they don't actually like to do a lot of the things that are being automated in the first place.
Right.
And there, so there's the fear, you're right, of losing a job. But really, it's like, do you want to keep, reviewing W-2s to see if they match stated incomes? Like, I don't think you want to do that. And so you can offload that and then empower them to really have a more value added discussion with your clients.
I think about like Zappos, originally where they had a certain amount that they could spend to deliver happiness or delight their customers, and we haven't quite figured out what that solution is. But I always loved that, like what it means to a customer to get flowers from their teller. I mean, that would
Mm.
be amazing.
Yeah, and that's to your point, the cultural piece. I don't know if you ever heard the story about Tony Hsieh, who started Zappos, but he like called in one time from somewhere not near the office, didn't tell anybody who he was, and like got the rep at Zappos to order him a pizza to his hotel, just as a demonstration to people about how much their team was culturally set up to just, your job is to make the customer happy, and if they called to order shoes, great, and if they called and they needed help finding a pizza joint, then like, find them a pizza
We can
joint
do that. Why
and
not?
leave them happy. I thought that was a fascinating example of what it really means to have a customer service culture that puts that client's happiness and satisfaction at the top of what your objective stack is.
Well, it's a mindset, right? I mean, more than anything else, it's the way that you think about serving your customers and what your job is. If your job is just to provide a balance or to make a transfer, then that's probably what you'll be good at. But if you realize that you're really there for service and commitment, those are things that I can get my mobile app to transfer money between my accounts, no problem, right? But
Yep.
but if there's something else that's behind that, that's something more. That's where I think the human touch comes into play.
I want to talk a little bit about fintechs. I know you've been on a bit of a journey in terms of partnership or engagement with fintechs. Tell me a little bit about kind of where you started, where you're going, and what that journey's looked like.
Sure. So, I was the CFO of a community bank in Seattle for 16 years, and I had the opportunity to, oversee the finance and accounting group, but also operations, IT, all the core processor and relationships, the mobile banking, bill pay, other types of strategies. Even
Mm-hmm.
back then, really heavily focused on e-statement and some of those things
Mm-hmm.
to try to save money and costs. I ended up leaving that organization in early 2018 and considering starting a digital first bank and wound up working for a small bank for a short period of time, and then coming to First Fed. And throughout that entire period of time, what I realized was, especially in 2018, 2019, you were seeing these tremendous valuations on fintechs like Upstart,
Mm-hmm.
and community banks were getting valued in a much different way, and all banks in general. So that if you earned a dollar, for whatever reason, that was valued at a much higher valuation than if a bank earned a dollar. And so I said, well, that's interesting. I've seen a lot of companies like Cross River and others that are participating as partners with fintechs. And at that time, they weren't necessarily getting value. Now, as of late, within the last 12 months, you see the Coastals and the TBBKs and the Silvergates of the world at tremendous valuations because they are being recognized for what they provide. But what I thought was, we want to own part of the fintech relationship. I want to have the rights to some of that valuation as it goes up. And so as a
Mm.
result, in late 2020, early 2021, we formed a joint venture with a company called Quin. We had formed the brand and ended up doing a partnership with a startup company called Peace of Mind to offer a product called Lifestyle Protection to provide financial wellness to folks who are really needing it. I think there's a huge amount of interest and demand for financial advice, for financial support. Many people
Mm.
feel like they don't know where to go or where to turn, and so we took that on as a way for us to try to help provide support to those folks, but also from a business standpoint. We had true skin in the game. We weren't just a sponsor bank
Mm-hmm.
for this particular outfit. We are their sponsor bank, but we also happen to be a significant investor.
That's interesting. Tell me a little bit more about what Quinn does and what Peace of Mind does, because I do think there's this. So much of the advisory area is focused on more well-to-do, right? Like my 401k versus my Roth IRA versus my IRA, and different investment strategies. I'd love to understand what those guys, what you're tackling with those solutions targeting you said the less affluent, population.
Yeah, absolutely. And I mean, it could go across the spectrum in terms of affluence, but really folks who are feeling like they're living paycheck to paycheck, that they don't have emergency savings, and that, given all of the uncertainty over the last 24 months, many people are very concerned about
Yeah.
their job security, even though, unemployment is low and there's lots of jobs available out there. And so what we've done is created a product that is packaged along with a relatively small limit credit card
Hmm.
offering, and what it provides is a form of financial support where we will make your most important payments if you lose your job above and beyond what you might collect from unemployment. We'll make payments on those most important bills for up to three months,
Hmm.
$1,000 a month. And what that does is, if you're collecting unemployment, perhaps you're able to pay your rent or pay for your food or pay your car payment, hopefully. But people are really worried about paying for their cable bill and their internet,
Yeah.
paying for their cell phone bill, paying for Netflix, those types of subscriptions, which is why we call it lifestyle protection. Hopefully you've got the needs taken care of from your basic unemployment benefit. I know a lot of people did with the supplement that was
Hmm.
provided by the federal government, but then you've also got these other things that are truly important, that you have come to expect and they're a part of your day to day life that you don't want to give up.
Interesting. That's a fascinating product. How did that? Did you find them with where did the bank kind of enter into the journey of the fintech and the development of that product? You seem to have a more active role in this, and I'd love to delve into kind of other relations with fintechs. But like, where were you guys at in the journey of developing that product, or where were they at when you kind of got connected with them?
So when I first came to the bank, I mean, my goal was to actually start a fintech from within the bank. So separate brand.
Mm-hmm.
So we worked with a great company out of Seattle called Turnstile Studios that actually helped us to create the Quin brand. We had a brand and a concept and somewhat of a preliminary go-to-market strategy. And we were looking for technology partners and folks who were experts at customer acquisition.
Mm-hmm.
I mean, community banks historically are great at one-to-one customer acquisition. The one-to-many piece, we leave a lot to be desired. It's not what we're good at. So we wanted to find partners who were.
Yep.
The two gentlemen that started Quin, one had come from Quovo and the other one had come from a company that he had founded called Vetter, which was an online account opening platform that sold to the small, mid-sized core DCI in early 2020. They were looking for a sponsor bank. And so we started a conversation, and I had known Brian, who started Vetter. He had called on me to sell that product several years ago. And the conversation kept getting better and better. And what about this? And what about this? And one day, the CEO, Will, said to me, "Hey, what do you guys think about a joint venture?" And we said, "A joint venture? Like between a bank and a fintech?" And they're like, "Yeah." And so we thought, that's interesting. And so we went back to our board. We had a number of conversations. We ended up making the investment.
Mm-hmm.
We're a publicly traded company, and we have a bank holding company. We had to go through an approval process with the Federal Reserve of San Francisco, made the investment at the holding company. And we structured it in a really unique way. We actually, instead of funding with equity, we've actually are funding it with debt. So we're providing 3 debt installments to Quin, and to be paid back in the future. It's been a really fun and exciting and challenging prospect. I mean, you've got a new brand with a new product no one's ever heard of. So, it's been fun and exciting, and we're in a soft launch right now. But we're really positive and optimistic about where it's going to go. The biggest challenge for us, because we're offering credit, is the demand for the product is down the credit stack, right? It's people who are either near prime or subprime, but they need it the most. So we're working on ways to address that and to hopefully be able to provide a form of Quin to those folks who maybe need some help building their credit and their credit score as well.
Let me ask you before we dive into that, because I do want to talk about this kind of broadening the credit spectrum that you can serve. But first, you've got obviously a very interesting engagement, making a large investment in a fintech, more of a joint venture kind of approach. What do you see as the future of the relationships between fintechs and banks? I feel like that's maybe on one far end of the spectrum, the kind of fintechs that are really taking it hard, kind of a direct attack, so if you will, on the traditional banking products is maybe on the far other end. But what do you see as where the world's heading in terms of how banks choose to work with fintechs?
I mean, I think if you asked banks 3 or 4 years ago, it was like the barbarians are at the gate and we're in trouble. And, what we found now is, largely 3 or 4 different things that have played out. One, you've seen the Radius Lending Club. We obviously have SoFi's deal that got approved yesterday. So you're seeing fintechs go and get bank charters, and they're willing to take on the regulatory burden and concerns, and they think the benefits will outweigh the cost there. And I think if they do it right, they're probably right. That's not a bad assertion. But you're also finding a lot of fintechs, the way that a startup works and the way that fintech works, a technology company works, they don't want to deal with all of the challenges of being regulated. And for better or worse, as a bank, we have some really valuable things to bring to the table, right? We understand the compliance and risk management. We have capital. We have extremely low cost of funds for lending out. We have abundant deposits to lend out. So I think those partnerships are transformative. I know it's a lot of what Upstart does. And the reality is they're great symbiotic partnerships. As long as the economics are aligned properly, I really think for a period of time, banks didn't necessarily appreciate or understand the value that they brought to the table. I think now that they do. The other thing I think banks are learning is that the economics, there's enough to go around. I think there's an economic model that works really well for the bank and really well for the fintech. And in the case of reaching out to the underserved population in terms of banking, it's worthwhile to those consumers to pay maybe a high rate. Maybe I wouldn't think, geez, I'd never pay 18% for a loan. But for them, if their alternative is, 50, 60, 70% from a payday lender or from some other check cashing location or that type of thing, it gets them introduced into the credit world. And then hopefully they can start to qualify for lower cost credit in the future.
You said something really interesting there, which was the alignment of financial incentives. How do you think about structures that make sense and getting everybody on the same page where we've got financial incentives that are aligned and an economic structure that works between fintechs and banks? I feel like there's, to your point, I've believed for a long time that fintechs really have to either partner with banks or become banks. We're now seeing
Yep.
we're seeing some that are taking the become banks path, and I think anybody who's left in the middle, who's neither really working with banks effectively or becoming a bank, like it's just not really a viable path as a business model. But how do you think about, for those fintechs that are working with banks, properly aligning the incentives and the economics so that everybody can win?
Yeah, I mean, I think the reality is there are enough economics to go around, and I think it's in the best interest of the fintechs to make sure that their banks are being properly
Yeah,
compensated
absolutely.
for what they're doing. But I would tell you, I'm sure there's some negotiations where the banks and fintechs come together in agreement. The banks walk away and they're like, "Oh my gosh, I can't believe we got this great deal." And then there's fintechs on the other side, and they're like, "Oh my gosh, I can't believe we got this great deal." So, I mean, I do think that there are some of those really great win-wins. The bank's bogey, if a bank is going to do a very low risk, or let's say credit
Yep.
enhanced extension of credit, their bogey for yield is not that high,
Yeah.
right? I mean, it's really not. And compared to the alternative that they're getting when they're doing a multifamily loan at 3.25%, or a 1 to 4 family loan at 3%, or some of the credit unions that do car loans at 2%, it's like, well, that's not very good, and there's some credit risk there.
Yep.
If you've got a credit enhanced lending opportunity, there really is a tremendous upside to a bank to say, hey, we're in the low single digits, and we're absolutely tickled pink because there's not much credit risk here, and then the optics and
Yep.
the economics for the fintech are also pretty strong.
That's a good point. So lastly, you alluded to this, like ability to use some of these partnerships to access parts of the credit spectrum. I know with like the Peace of Mind type product, you're really aiming at a consumer who's not, a typical prime consumer from a credit score point of view, probably from an income point of view. What do you see as the future of how we enable institutions, banks, credit unions to actually, better target across the credit spectrum? Where are the opportunities that are in the kind of maybe less appreciated portions of the credit spectrum?
I think there's 2 or 3 ways to do it. I mean, one of the ways that seems really successful and is getting more and more in vogue these days is a credit builder product
Mm-hmm.
where you basically provide a secured loan. And I do think that's a very viable product and one that makes a lot of sense. If sold and managed responsibly, I think it's, almost zero risk for the issuing institution, and I think could be a really good solution for the consumer. In an ideal world, you take out a credit builder loan, you pay it back over 12 to 24 months, you've got emergency savings, right?
Mm-hmm.
Or you have collateral for another form, maybe a credit card. I mean, there's really some great options there. If everybody follows what they said they would do, I think that could be a real win-win. I also think there's certain, banks are willing to take, as I said, credit enhancement. So if there were companies that came in almost like in the insurance where you had a reinsure, if you had folks that said, hey, we'll take a pretty significant amount of this yield and we'll provide you credit enhancement for that. I do think if handled right, that could really work and could be a great opportunity. I think right now you're seeing that where some fintechs out there are taking the majority of the credit
Mm-hmm.
risk. They're not necessarily deploying as much capital because it may be the bank's
Mm-hmm.
capital. The bank is taking a good yield, but not as much as they could get, and some credit enhancement. And I think that option is also working fairly well, where the cost of capital to the bank is significantly lower than it is to the fintech.
Yeah, obviously fintechs don't have. I always kind of go back to the fundamentals of banking, and people, well, what do I say? Well, yeah, I don't know what you pay on your loan and what you make on your checking account, but those two things are usually pretty different. In that delta is where a bank can make their money, and certainly we don't have access to funds that are anywhere near at least what I get paid on my checking account. Maybe somebody's making better
Until you get a charter.
until I get a charter. That's right. I'm not. It's not an announcement for me that we're getting a charter unless we show.
No. I understand. Hey,
Yeah.
Jeff, one other thing I
Yeah.
wanted to say that I've noticed and I have a lot of admiration. A lot of fintechs are coming in as vendors, right? They're
Yep.
serving the banks, not necessarily in an economic, mutually beneficial way. The bank's hiring the fintech as a vendor, but we've got great partners for mortgage and online account opening and consumer lending, even commercial lending. That I think they play a valuable role. There's a lot of reg tech companies
Yeah,
out there
a
as
hot
well
space
that
right
are
now.
helping with KYC, AML. And so, it's kind of fun to see that, but in almost every circumstance, the banks or the financial institutions and the fintechs are working
Mhm.
together. And I think that's where the most value gets created.
I think that's right. It's fascinating to me that in some ways we think of that as new, like fintechs used to be the barbarians at the gate, and now we're working together. But really, if you think about the history of the industry, like your core providers are fintechs at some level. Like banks have always worked with technology companies to very few banks like at the core build their own core banking system, deposit opening process. Like, you didn't do check processing on your own. There's a lot of things that have always been, using highly specialized technology players to provide capability. And so it's interesting to me that we think of this fintech bank partnership as a new wave, but I kind of feel like it's back to basics in the original business model, which was technology companies that were really producing technology that was useful for financial institutions, and they would work together to provide the best solution to their customers. And I feel like that's going to be the ultimate winning combination.
Well, and if you think about it, you look at FIS and Jack Henry. I mean, those are two of the best performing stocks over the last 25 years across markets. And so, there's been a lot of value for those original fintechs, if you will,
Mm-hmm.
and a lot of banks who, have done really well partnering with them as
Yeah,
well.
so I'm excited to see, the new waves of fintechs. I think will go through that same cycle and end up, some of them choosing, if you are, in the SoFi camp, will say, since I guess today they announced that they've got their conditional approval for a charter. You're gonna take the route of becoming a bank. I mean, banks are great institutions. A couple more is not a bad thing. And some that are maybe digital first. But I think for many fintechs, the future of, hey, we're going to become a partner to banks that provides technology capabilities to enhance the customer experience is value for the institution, but also value for the fintech. To your point, that you can do pretty well as a business providing those kinds of services. It's a big unmet need.
Absolutely. And I think the partnerships can lead to, add-on
Mm.
products and maybe you start out with one set of products and then you see other opportunities. I think the data analytics that a lot of the fintechs bring to bear is superior in saying, hey, you could also offer them this product or did you know they have, you think about what Plaid has done. It's like so many financial institutions, banks or fintechs or otherwise have a lot of information about the activity in your accounts and we've willingly shared that, right? I do it all the time and so how do we use that data? And I think that we think about how we might manage that data within the bank, but there's also opportunities with fintech partners to lever into their skills and capabilities that are oftentimes very distinct from a traditional
Yeah,
banker.
I think that's right. It's very hard to build a technology organization inside a bank that's at the same scale and depth for those kinds of capabilities. And it's not, to your point, it's not the core competency. And those are the best kinds of partnerships where you have different core competencies that are complementary and the 1+1 is greater than 2 kind of result. Well,
Absolutely.
Matt, those were the main topics I had on my list. Was there anything else you felt like you wanted to talk about or you expected to get asked and I didn't bring up?
I think there's going to be a lot more banks that are coming into this space. I mean, there's some great trailblazers out there. We're somewhat of a fast follower.
Mm.
We're looking really hard at what we're doing with partnering with fintechs for payments, looking at some marketplace lending, looking at some other ways to provide services in communities and industries that are underserved. And it's a fun time. It's probably the most exciting time of my career. It's a little bit harrowing as well to think like how fast things are changing.
Yep.
But it's great, and I believe in the power of and. We've got a great community bank. We really believe that we can continue to be a strong and viable community bank for a long time. But by adding in some of these fintech partnerships and relationships, we can do both, and we think we can do both very well. And that one complements the other. And, that
Mm.
without the basis of the community bank, the infrastructure, the capital, the board, the governance, we wouldn't have been able to go into the fintech endeavor the way that we have, and ultimately we hope to reap the benefits of these investments.
Yeah. No, I think that makes a ton of sense. Do you have advice as you think about how you go into those places and make those investments, how you do it effectively? This is something I asked a lot of, I think, bankers I've had on here, but I feel like figuring out how to make those partnerships effective, both in terms of, maybe all three in terms of finding the right partners, executing your getting on board, making a decision process, which for a bank can be, very bureaucratic in many instances, and then kind of, actually getting into market and successfully managing a program on an ongoing basis. I feel like all three of those are skill sets that banks need to develop. And I'm curious if you have any key lessons from your experience doing these things on how you can be effective at any of those phases. Because I feel like for a bank to make the most out of those opportunities, they have to be good at ultimately all three of these things.
I think you have to create an infrastructure and a process, but not be too bureaucratic. You've got to be entrepreneurial, but also keep in mind, the compliance challenges that we face. We've already found we're getting tons of at bats. So, even though we're relatively new into the fintech space, because we are a fintech sponsor bank now, we're getting lots of looks and opportunities. So then it's really coming up with a proper vetting process and really not knowing and trusting who you pick, and also understanding that early on, it's easy to walk away. I mean, if you don't feel good about a partnership opportunity early on, it's easy to walk away. I think it's something that is critically important for banks to do. They need to know who they're partnering with. And as you said, for fintechs, knowing the bank that you partner with is going to be hugely successful, because it's easy to paint all banks with a broad brush. But the reality is there are a number of us who are innovative, who are looking to do things a little bit differently, who do have the expertise in the compliance and the risk management and the low cost of capital, that I think it's important on both sides to really understand and make go through a very thorough vetting process before you make a decision of who you might want to partner with.
I've certainly been through a few of those vetting processes. They are quite thorough. Well, Matt, I appreciate your time. I have the same three questions I like to ask everybody at the end of this podcast. So I'm going to throw them at you now and would love your thoughts. Number one, what's the best piece of career advice you've ever gotten?
Well, I'm gonna paraphrase because I think it sounds better. But I worked for an accounting firm out of school, and the partner there, when I worked in the office, it was a very small office, and I'd be out leading jobs and wondering, Mike, what do I do? Like, I'm talking to boards and CEOs and CFOs, and I'm a 24-year-old kid, and he's like, make me look good. And I thought, I think he actually said, "Don't make me look bad," but make me look
Turn
good
that around
sounds
to
better.
positive.
And it's true. I mean, you think about it, like, who do you work for? If it's me, it's the board. If it's somebody else, they have a manager or whatever. Like, what would they want you to do? How do you make them look good? Maybe you're doing something they could never have thought of on their own. But if it ends up being a successful story and you're their employee, like, you're going to make them look good. So that gave me a lot of confidence, and I thought, you know what, I can do that. And I think for the most part, that's been a good piece of advice to follow throughout my career.
That's what I tell the podcast team every time I record one of these before they get it out. They make me look good. They tell me there's only so much they can do with what I give them.
That's hard. That's a heavy lift.
So it's a high order task for them to do. So my second question is, what's the best piece of advice you've ever gotten about consumer banking or consumer lending?
I think that you've got to really think about the fact that you've got people on the other side. And, when you're dealing with someone who's applying for a loan, they're putting themselves out there to be rejected. And I think that's really hard for a lot of people. And I think that's partly the reason why online applications might be easier for someone to fill out than an in-person application, because it's much easier if you just get the rejection notice on your iPad, as opposed to someone, telling you no. Yeah. And so I think there's a lot of pride and a lot of also some insecurity for people as it pertains to financial decisions. So I think really understanding, having the empathy that you've got a person there, maybe finding a way to help them out. If you turn them down for a loan, is there an alternative product that might work for them? And really helping them to understand. A lot of times people want to borrow money and they don't realize that you could qualify them for the loan, but that might not make it a good thing for them.
Yeah.
And they might feel good at the moment the loan closes, but I think it's also important to understand, that whole notion of ability to repay, what's good for them. Do they understand what they're getting into? And so just understanding it's not just, zeros and ones and credit scores and AI and ML and all these things. It's also human beings on either side of the transaction.
Yeah, I think it's so true. There was a really fascinating article about, I can't remember, somebody from one of the large credit card banks, and how they kind of like, their game ended up feeling, their job ended up feeling like a video game, twisting knobs and playing an Excel spreadsheet to make this number go up and that number go down, and not stopping to ask the question sometimes, like, is what I'm doing helping the person who's, it's not just a game and numbers and an optimization function. It is ultimately like people, and are we doing right by those people? And that's the only thing anytime you can keep those people at the center of your perspective and your, what you're doing, that's probably pretty helpful. All right, last question. What's one bold prediction for the future?
Well, I don't think buy now, pay later is a fad. I mean, I think that it's kind of fallen out of favor recently, and some of those stocks have gotten beaten up. But, we've been in the buy now, pay later business in this industry for hundreds of years. And what do? We trade cash flows, right? That's all we do. So if you're saving money for a purchase later, save now, buy later. If you're borrowing money, it's almost always to buy something. And it's to buy it now and to pay it back over a term or a period of time.
Yep.
So that's what we do. We facilitate payments, whether or not it be in real time or whether or not it be helping you save for something in the future or not. I think that that's an important way of thinking about what we do and how we do it. And everything that is old is new again, right? It's layaway with a different name and a different timing of cash flows, but that's about it.
Do you think that the new players, by integrating into the merchant checkout and making things available at that moment, and also I think the other thing I see is this shift towards two shifts. One from kind of the revolving credit card style credit to an installment credit for at time of purchase, which has been not maybe the norm for the past 20 years, and the easy integration of merchant side incentives, right? So a lot of those are like zero interest offers. Do you think that they're doing something fundamentally new or innovative in that space? Because it feels to me like part of me thinks everything old is new again. We've been doing layaway for decades. Like, it's not actually new. And part of that does feel like a set of capabilities that have been brought to bear that are at least in some way meaningfully different than what was available for consumers beforehand.
I don't think there's any question about that. I mean, it's really a new payment rail, right?
Yep.
Instead of using Visa, MasterCard. So to me, the beauty of it is, and granted, a Visa or MasterCard is typically an extension of credit, but you've got this notion of a different payment alternative. Maybe the merchant's willing to pay for that,
Mm-hmm.
both as a cost of sales, but as an alternative to paying for
Mm-hmm.
interchange. And to the consumer, yeah, maybe they do think it's better, and maybe if done properly, maybe that is in certain cases better for the consumer. They know, like, okay, these 8 weeks or whatever, I'm going to have this extra money coming out, and then it's paid
And then I'm
for.
done. Yeah.
And I think that notion of embedded finance with the merchants, I mean, it's coming. It's going to be interesting to see how that continues to evolve. I think that's a little bit of an overused term, but I do think it's a real thing, and it's impressive if nothing else. I mean, you look at the Affirms and the Afterpays and the Klarnas, and it's like, wow, how did they do that? I mean, they are all the way in, some of these huge
Yeah.
merchants, and really, the lead form of payment for many transactions
Yeah.
today.
It's a pretty impressive execution on their part.